Okay, I started recording and it kind of stopped on me. So I'm going to start again. We're looking at chapter 9, which is partnerships. We're looking at formation and operation. And we're going to start by explaining the advantages and disadvantages of partnerships. Basically, what the partnership is it has a simplified form of starting businesses compared to other forms, other business forms like corporations. So for partnership, basically we have, two or more people who are going to be in business together. And for, I would say for Guam purposes, we don't need to file anything aside from just obtaining a business license. But we may want to sort of draft some sort of agreement just to make sure that, everyone in this partnership is clear about, how are the profit and losses gonna be divided among the partners, who's gonna bear the risk and things like that. So a major advantage I would say of the partnership, I'm not too sure at this point because of the new law, but it used to be the partnership was more advantageous because there's no double taxation as compared to corporations. So for example, if net earnings from the partnership will be $100 and these were distributed to the partners, then the partners will have to pay taxes on their ordinary income. So it's a flow through entity. The partnership does not pay taxes, but the partners do. On the other hand, corporations have to pay taxes, and then the earnings are distributed to the shareholders, which in turn will have to pay another level of taxes. So that's what we mean by double taxation. But as we know, under the new law, the corporation's tax rate has been reduced to 21%. So this is interesting to see which of the two entities may or may not be more advantageous. So as we said, I guess here we're talking about how the corporation, so another advantage will be that corporations are limited on the amount of net operating losses that they're able to carry back and carry forward. Although due to the COVID-19 tax law changes, now corporations are allowed to carry back some net operating losses. But in any respect, in terms of partnership, if like we seen in chapter 13, oh, I'm sorry, I'm talking about tax. But as if you recall your tax class, your at risk and your basis, if there's sufficient basis, the partner can deduct losses from the partnership. Okay, so disadvantages would be if we have a general partnership, will be the unlimited liability. So all partners are, at risk of creditors coming after their own personal assets. So because of the mutual agency, so each partner, so if all of us in the BA 400 class were to form a partnership, each one of us could engage in a contract and sign that contract, and that be a binding contract for the entire partnership, even though other partners may not be aware of that. And so we are putting our assets at risk, not only for the partnership, but also personally. So that's the general partnership. There is under the United States Commerce Law, there is a Uniform Partnership Act that guides the partnership agreements, just standards, general standards that we can follow. and also defines what the partnership is, which we stated earlier. There are other types of legal forms of business entities. It could be, we could form, instead of a partnership, we could form an S corporation, which will provide the limited liability that we are looking for. The only thing is that S corporations are limited to 100 stockholders. We could form a limited liability partnership, in which case, the partners can be limited to the amount of their loss, based on, so if you would have to engage in a contract, and or you're assisting a client and that customer or client is dissatisfied and sues you, then the other partners are protected. So only that partner will be at risk, and the rest of the partners in that partnership will be protected. Another entity is the Limited Liability Corporation, in which case it could be taxed as a corporation or a partnership. So it provides a lot of flexibility. In terms of partnership, we have to pay attention to the capital accounts. So capital accounts are basically our net assets, so, or our sort of equity section on the balance sheet for a corporation. So instead of having equity, we're going to have our partners' capital accounts. So this just talks about the articles of partnership, and you can take a look at this in your textbook. It just has some more details about those standards that I was talking about. So I'm just gonna go through this and then talk about the journal entries that are required for our initial investment in the partnership. So if the partners were to contribute cash, we simply debit cash and we credit each partner's respective capital balances. If partners were to contribute assets, so in this case we have Carter. Carter has invested $50,000 in cash, and Green contributes assets. So take a look at the difference between the book value and the fair market value of these assets. And you'll notice that for the most part, for inventory, for building, our fair market value exceeds book value. But for land, our fair market value is less. In essence, this wouldn't matter for financial reporting purposes, because we're going to use fair market value to when these assets transfer to the partnership. So in this case, we have the cash that Carter had contributed, and then for Green, we have the assets at fair market value. Now, one of the assets, the building, had a mortgage, which the partnership is going to assume. So if we remember, the total fair market value of the assets was $67,000. So instead of crediting Green's capital for $67,000, we're going to deduct the amount of the mortgage that the partnership is responsible for now. So this comes to $43,400. And we added the liability for the $23,600. Okay, when we have an investment in the partnership, our initial investment, if we have an intangible, then we have two methods that we can use to account for this intangible: the bonus method and the goodwill method. So the bonus method is illustrated here. So we have James, who contributes cash for $70,000, and Joyce invests only $10,000. So we have a total of $80,000 in cash. However, the partners are want to split their interest in the partnership 50-50. So we're going to debit the $80,000 cash, and then we're going to split their capitals in half. So 40,000 to James and 40,000 to Joyce. Now, even though Joyce contributed only 10,000, she's been crediting with an additional $30,000 to her capital account, and this 30,000 is actually the bonus for her know-how, for whatever intangible she brings to the partnership. So the other method is the goodwill method. So what we're saying is Joyce only contributed 10,000 while James contributed 70,000. So that means that there is a 60,000 difference that we are attributing to Joyce's know-how or expertise in this industry. And so this 60,000 is sort of the goodwill to Joyce. So we're going to have our 80,000 cash that we received from the two partners, 70,000 from James, 10,000 from Joyce. And then we're going to recognize the goodwill that was implied from the small contribution in cash that Joyce made. And then we're going to credit the capital balances. So note here that James is actually being credited for the amount of cash that he contributed, and Joyce is given the 10,000 plus the 60,000 of implied goodwill. If the partners were to contribute any additional cash to the partnership, then that will be used to increase their account balances. Partners are able to draw out money from the partnership, and so if that's the case, we're going to debit drawing or draws and credit cash. So in a way, drawing is like dividends. Okay, so now we go into the allocation. So the operations of the partnership. We are already established, we form our partnership, and now we have to account for our income or losses, and how is our special arrangements, how is that going to affect the partner's capital account. So let's assume that we have Tinker, Evers, and Chance form a partnership by investing 120,000, 90,000, and 75,000 respectively. Evers will be receiving 40% of all profits and losses, and Tinker and Chance will split 30-30 on the remaining. Each partner will receive, or actually will be able to draw out 10,000 in cash annually, and net income is 60,000. So I'm just gonna skim through this, and then what we have here is each partner's beginning capital balances. We have the allocation of the $60,000 net income based on their P&L percentages. And then we have their draws, which come from their capital accounts and will reduce their capital balances. So we end up with 315,000 of capital on the balance sheet. Okay, so what would happen if we still have the same three partners, but in this case we have different stipulations, one being that they are to receive interest equal to 10% of partners' beginning capital balances, and they're going to receive 15,000 of compensation, Evers and Chance each, And then we continue to split their profit and losses as 30%, 40%, and 30%. So if you recall, their beginning capital balances was $120,000, $90,000 for Evers, and $75,000 for Chance. And we have net income of $60,000. So the first thing that we're allocating is the 10% of their beginning balances. So 10% of 120 for Tinker, he receives $12,000. 10% for Evers, 90,000 of his capital. He receives 9,000, and 10% of 75,000. 7,500 is credited to Chance capital. Now, the total amount reduces the amount of net income. So this interest is going to decrease the overall net income of the partnership. And then we have compensation for Evers and Chance of $15,000 each. And this also going to further decrease our net income. So all we have left to distribute based on their P&L percentages will be $1,500. Now, if after the allocation we have a loss, whatever loss, we still have to distribute it based on their P&L percentages. Okay, so in terms of dissolution, so there's different events that may cause a partnership to dissolve or change partners. Could be retirement, could be death. We can just have new partners trying to or wanting to acquire the partnership. So when we're talking about new partners that are joining our partnership, we need to pay attention as to who are they making the payments to? Are they making the payments to the partners, or are they making payments to the partnership? Okay, so when we have a new partner, now there's 3 rights that partners are entitled to have. One is the co-ownership of the property. One is the rights to share profit and losses. The third right is the right of management, participate in management. And this has to be approved by the existing partner. So it's not like automatically they're going to be allowed to manage the partnership. So there should be some sort of clause or some sort of agreement between the partners how this is going to be handled. Okay, so in terms of admitting a new partner, we have 2 methods, the book value approach and the goodwill approach. And we're talking about when cash goes to the partners and not the partnership. So assume that we have 3 partners, Scott, Thompson, and York, and they form a partnership, and York wishes to retire from this partnership and sell his interest to Morgan. We have what their book values are as of the day of this transfer. So Scott has a 20, and we have their respective P&L ratios. So Morgan wants to acquire 20%. Wants to acquire a 20% interest in this partnership and is willing to pay $30,000 for it. And the money is being paid to the partners, not the partnership. So we're not going to debit cash because the partnership is not receiving any cash. Instead, we are going to debit the 3 existing partners' capital accounts 20% of the $30,000. And then we're giving a 20% interest to Morgan. Now, in the other method, so this was the book value method. In the goodwill method, we're going to have to do a reassessment or find out what is the implied fair market value of this partnership. So basically, if Morgan is willing to pay $30,000 for a 20% interest in the partnership, then the implied value of the partnership is $150,000. And we compare this to the actual book value. So it looks like we have a $50,000 of goodwill. So we're going to record the goodwill and then credit each of the existing 3 partners' capital accounts based on their P&L percentages. And then once that we have increased their capital accounts, then we take out the 20% for each account to give to Morgan. And so in this case, Morgan is actually being credited for the full amount of cash paid to the partners. Okay, now what happens if instead of paying the partners, the new partner is paying the partnership directly? So let's assume that we have a partnership with 2 partners, King and Wilson. King has $80,000 in capital balance. Wilson has $20,000. And their P&L percentages are 60 and 40 respectively. Now, let's assume that the partners agreed for Goldman to join their partnership, and Goldman is going to pay $20,000 directly to the partnership. So in this case, and he's receiving a 10% interest. Now, in this case, we are going to debit cash because this partner, this $20,000 is going to the partnership. So under the bonus method, so once again, we have a bonus and we have a goodwill method. So we had their original capital balances was $80,000 and $20,000, and then plus the $20,000 that Goldman contributed to the partnership. So our book value in this partnership right now is $120,000. Since we're giving Goldman 10% of the 120, then we're going to credit Goldman's capital balance by 12,000. So 10% of the 120,000. And then King and Wilson will receive a bonus split up based on their P&L percentages. If we're using the goodwill method, we're going to assess a fair market value. So again, we take the amount of cash that's being paid to the partnership divided by 10%, the interest that Goldman is supposed to get. And so we have an implied fair market value of $200,000. And we subtract that against the book value. Again, we're adding the $20,000 that is contributed to the partnership. And so we have goodwill of $80,000. So we're going to book our goodwill and credit King and Wilson's, the existing partners' capital accounts, increasing their accounts by the goodwill, and then accept the cash from Goldman and give him a credit for him or her the $20,000 that they paid into the partnership. We have to record the withdrawal of a current partner. So this, I think this is our last learning objective. So just hang in there. If a partner desires to leave the partnership, we have 2 methods to deal with it, where you don't have to worry about the hybrid method. We're looking at the bonus method and the goodwill method. So under the bonus method, we have that the book value of this partnership is $100,000. Windsor is the one that wishes to leave the partnership, and he holds a 20% interest in this partnership. The partnership has been revalued, and so we know that the fair market value is $180,000. So there's an increase in the value of this partnership of $80,000. And so what Windsor is going to receive is going to be $26,000, which represents $10,000 of his capital balance plus 20% of the $80,000 excess between the estimated fair market value and the book value. So under bonus method, we simply remove Windsor's capital balance, and then let me go back to the percentages. Duncan had a 50%, Smith had a 30%. If Windsor is gone, the remaining is 80. So just to reassess the new percentages, what we have is Duncan 5/8 of the distribution, and Smith has 3/8 of the distribution. This 16,000 is 20% of the 80,000 in excess valuation. Trying to write on this is not fun. Okay. So this 20% of the 80,000 excess valuation is split between Duncan and Smith based on the remaining percent fraction. So this Duncan had 50%, 50/80s or 5/8s, and then Smith owned 30% or had a P&L of 30%, so 3/8. That's the fraction. For goodwill, we know that the 80,000 excess comes from 50,000 from land, and then the remaining is 30,000 goodwill. And so we're increasing the existing partners' capital balances based on their P&L percentages. And so that will make Windsor, because we started with 10,000, we added another 10,000, and then we added another 6,000. So that means that Windsor's capital balance at this point is 26,000. So all we have to do is debit his capital balance to zero it out and credit cash. So that pretty much ends our presentation. Just make sure to post your questions on the course Q&A that'll be posted in Moodle.